Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking about US real estate, and my guest is Bob Jenkins, Global Head of Research for Investment and Wealth at the London Stock Exchange Group. After a dour 2023, could US real estate be getting that festive feeling? The sector has been beaten down by a higher rate environment and concerns around commercial real estate, mostly offices. But rate expectations and inflation have been softening, and its fans say it's well positioned for a rotation out of some overvalued sectors. Needless to say, that's mostly techs, meaning that 2024 could offer the prospect of a happy new year and some much wanted relief for those already in this space, which has underperformed the broader S&P 500 by around 17% year to date. Well, with me is the London Stock Exchange Group's Bob Jenkins. Bob, many thanks for joining us today. Let's look at the broader outlook for the sector first of all, which is up, as we said, around 7% year to date, but on the quarter is up around 17%. So a massive recovery seems to be underway there.
You know, you're right. It's been a little bit of a rocky ride for the real estate sector this year, and it's been mostly predicated, and as you mentioned, since November, we've seen about a 17% rise, mostly predicated on the anticipation of lower rates. And in many ways, the market has kind of pulled forward what they expect to be a lot of rate cuts and reductions over the course of the next year. And so we're seeing that now, and that's created kind of optimism for the real estate sector now. But I think if you want to have it do well going into 2024 and even the next year, you have to have that lower rate environment coupled with the soft landing environment to really work, right? And even then, I think you have the kind of I would caution about potentially a bifurcated market. Anything that's touching residential is probably going to do pretty well. There's a ton of pent up demand there. On the commercial side, I think you have to look a little bit and pick your spots because, again, anything that's tied to residential, multifamily, et cetera, probably going to do pretty well. But in the commercial space, particularly the office space, as you mentioned earlier, David, I'm a little bit worried about some of the fundamental changes that are taking place there.
So lower rates will mean a collective sigh of relief, probably for those invested in commercial real estate. But does it mean that worries over the banking sector's exposure to loans in that sector have gone away?
You know, at the end of the day, the higher rate environment, right, David, it's just been bad for both commercial and residential real estate. Of course, has created kind of a logjam in both spaces, and it's been around financing, et cetera. Really, the only real winners right now are home builders. When you think about Lennar, Pulte Homes, and Toll Brothers and firms like that, 50, 60, 70% returns, some even triple digits. So it's been a great year for them because they've actually represented an outlet for some of the financing related issues for residential buyers. But when you think about, again, as you mentioned, the commercial office space, financing has been very tough there. And you have a lot of existing properties, particularly older properties, that are having difficulties getting loans. In general, the lenders have been a lot more conservative. Some of them are these regional banks who we know have had some issues over the course of this year. So that's kind of creating a little bit of a problem in terms of keeping their current properties financed. And they're also having some issues around vacancies right now.
But as you say, the market as a whole is bifurcated. Residential real estate doing pretty well at the moment. And of course, mortgage rates have come off some record highs.
They have, you know, and we've already seen, even in the past few weeks, that we've come down below 7, that the mortgage applications have gone up. So that's kind of a good sign. But will that actually unlock all the supply? And again, as everyone as well knows now, all those rates in the 2 and 3% range that now homeowners have and are enjoying in their mortgages, it kind of makes them reluctant to put their properties on the market. So I think if you start getting rates back down lower 6s and maybe even upper 5% range, you might see more supply come on market. I don't think it's going to lock everything. It actually might even be kind of a healthy unlocking of supply, so you don't have an overall crash, if you will. But when you look at the commercial side, yes, if we were able to get some financing, that could help, I think, maybe limit some of the issues we have there. But at the end of the day, it's more of a fundamental shift. So, of course, work from home became, a trend during the pandemic. And then it wavered a little bit afterwards, but it seems to be holding on. And that's making vacancy rates very high. And particularly in some of the older buildings, we have some new projects that may have stalled out a bit, again, due to financing, et cetera, coming online. It's going to put even more pressure on tenants and occupancy in those older buildings. And so you have that, again, that issue of a fundamental shift. Many experts feel like there's going to be kind of a change in some of the major corporate headquarters cities like New York, like LA. If you're having tenants who no longer want to go to work anymore, maybe move to a cheaper locale, and companies kind of buying into that and saying, you know what, let's not hold on to this real estate in these expensive locations. So this is a fundamental thing that's going on. So therefore, if you look at the overall real estate sector, residential is probably going to be a winner. You're going to have to really pick your spots in the commercial side.
Okay, Bob Jenkins, Global Head of Investment and Wealth Research at the London Stock Exchange Group. Many thanks for sharing your insights today. And that is your roundup of the US real estate sector. I'm David Pollard, and this is Reuters.